Global markets are mixed ahead of key US inflation data tonight. China lets its currency strengthen in what could be a signal before trade talks with the US. Australian firms' capex plans lift, and New Zealand's businesses are still struggling. That's coming up in our 5 Things in 5 Minutes on Friday, August the 29th. And in our deep dive interview, ANZ Chief Economist for Southeast Asia and India, Sanjay Mathur, looks closer at Malaysia's economy.
Growth prospects for Malaysia, particularly into 2026, will be challenged by the confluence of slowing consumption, exports, and a moderation in investment.
But first, in 5 and 5 with ANZ, markets meandered ahead of key US inflation data tonight, although a slight upgrade in estimated US GDP growth in the June quarter to 3.3% from 3.1% did help sentiment. Meanwhile, in other global news, China's authorities have continued to let its currency strengthen in recent days, which has caught the eye of ANZ Chief Economist for Greater China, Raymond Yung.
We see that after the Jackson Hole, that the Chinese central bank continued to fix its way below the spot level. And now that it's broke the 7-Eleven's handle, we call it, and fix it at a very strong level as well. That could also be a signal for China to tell the world that they don't mind a strong renminbi. They don't mind that the renminbi to be very strong ahead of the end of the trade talk with the US.
As of 4 a.m. Sydney-Melbourne time, the S&P 500 and Nasdaq were up 0.3% and 0.6% respectively. The 10-year US Treasury yield was down 3 basis points at 4.21%, and the 2-year was up 2 basis points at 3.64%. Gold was up 0.8% at a 3-week high of $3,476 US an ounce. West Texas oil futures were up 0.6% at $64.56 US a barrel. The US dollar index was down slightly by 0.4%. The Aussie dollar up 0.5% at 65.36 US cents. And the Kiwi was up 0.7% at 58.89 US cents. Number 2, Australia's capital expenditure rose 0.2% in the June quarter after a fall in the March quarter. ANZ senior economist Adelaide Timbrell says capex has largely gone sideways in recent years.
It seems to be that rising building costs are having an impact on feasibility for capital expenditure. And also the slow economic growth up until recently has made it difficult for businesses to see it being a good time to invest. We think that business investment will get better probably more closer to 2027. Though encouragingly, capital expenditure plans for non-mining businesses bounce. And that is a great sign for business appetite for risk and capital expenditure in the coming year.
Number 3. ANZ's New Zealand Business Outlook survey showed headline confidence rose another 2 points in August to a net 50%, expecting better conditions. ANZ New Zealand Chief Economist Sharon Zollner says there were some concerns, though.
When you look at what firms are saying about their activity here and now, it was down 5 points, and it's just +1, which is basically 0. So there are as many firms saying that they're going backwards as forwards, which is not what you would hope for. Past employment is -12. So there are definitely more firms saying they're reducing staff numbers than increasing them. So it's clearly pretty tough times out there.
Number 4. Sharon says at least some sectors that needed a boost got a bit of a bump.
Retailers' past activity jumped to admittedly 0, but it was -16. So it does appear that some people went out shopping, and also a bit more optimism about the outlook for residential construction. And that can't come soon enough, because what we saw from the construction sector was that their reported past employment absolutely tanked, suggesting that firms are letting staff go.
Number 5. The Philippine Central Bank cut rates for the 3rd time in a row to 5%, as expected. Meanwhile, the Bank of Korea left rates on hold at 2.5%, although not unanimously. ANZ economist Crystal Tan says a shift in the forward guidance towards a cut was notable.
There was one member dissenting in favor of a rate cut that basically referenced, slowing housing markets. So he felt that, it's time that conditions are now more favorable for a move. The forward guidance also shifted. We now have 5 out of the 6 members, excluding the governor, indicating openness to a rate cut within 3 months. So that's up from 4 at the last meeting in July. So basically, these are reinforcing expectations of a potential move in Q4.
Crystal Tan there. Now, in our deep dive interview, Chief Economist for Southeast Asia and India, Sanjay Mathur, visited Malaysia recently to analyse its economic performance and outlook.
We've generally felt that Malaysia has had a very balanced growth that's spread across consumption, investment, and exports. And really, the objective was to see whether these drivers of growth are intact and will remain intact in the coming quarters. We came back feeling a lot more cautious on growth. The first thing is that now as tariffs are coming into play, there is some pressure that's developing on exporters, not so much in terms of demand, but at least in terms of margins, because they're the ones who are having to absorb the tariff. This will hurt their investment going forward. The second is that even the other drivers of investment, say like data centers, they are looking a bit exhausted right now. And I guess the third point really comes down to household consumption, which has held up well, but there is very little reason to believe that it can incrementally strengthen from here on. So net, I would say that growth prospects for Malaysia, particularly into 2026, will be challenged by the confluence of slowing consumption, exports, and a moderation in investment.
How much of an impact has the tariff situation had on the outlook for Malaysia?
The tariff situation until now has not had much of an impact, largely because of the pause on the tariff hikes. It seems now it is starting to bite, and this is also starting to sort of find its way into exports. So what we find is that domestic exports of technology, of old traditional items like furniture, etc., have all started to take a breather now.
And looking at the role of the government in terms of public capital expenditure and also what it's doing in relation to spending and consumer spending, how is the fiscal situation looking?
The fiscal situation is not unduly difficult, but at the same time, there is little flexibility on this front. A month ago, the government announced that it had rolled out some welfare measures that amounted to about 0.14% of GDP. Now, this will have to be managed not through an additional budget deficit, but by cutting other forms of spending. The second is that if we look at the budget deficit for the first half of the year, it's certainly higher than the full year target of 3.8%, which implies that in the second half of the year, fiscal policy will have to be tighter than what it was.
And looking at the current account situation for Malaysia, how's that travelling compared to previous expectations?
Malaysia's current account surplus has narrowed a lot. It's just almost flat at the end of the second quarter, and much of this has to do with the fact that there is a differential pace of increase in exports and imports. Imports are still necessary because that is dictated by capex cycle, which admittedly is slowing, but nonetheless it's raised demand for capital goods. Second, they are also investing a lot in data centers, which eventually would lead to higher services export, but that's more of a 2026 story. So for the coming 2 or 3 quarters, we can expect a fairly narrow current account surplus and narrow BOP surplus/deficit at the same time.
And the performance of the Malaysian ringgit over the next year or two, how is it shaping up given all these factors?
We do not see new catalysts for the Malaysian ringgit absent a weaker dollar. That in turn would sort of ignite portfolio flows into the region, not just Malaysia, but on its own idiosyncratic strengths, we think that there is not very much that would support the ringgit from here on.
Sanjay Mathur there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Friday, August the 29th. Catch you next week as we get ready for Australia's June quarter GDP figures. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.